A lot of investors look at Tesla and argue that the stock is really expensive because it has a high PE ratio.
You're talking about just under a 60 times multiple, right? The industry trades at 7 times.
But is it really that expensive? Well, if we only look at the PE, you risk missing on a great stock because you're looking at an incomplete valuation metric for such a fast-growing company. Today I'll showcase a better metric to value Tesla, which shows that actually Tesla stock is not that expensive.
Hold up, wait a minute.
Alright, so we all know that Tesla has a really high next 12 months PE ratio, around 77 times, and it became even more elevated recently, growing from 42 times at the beginning of 2023. If we compare it to the auto industry, that's indeed really elevated, showing that Tesla is around 5 times more expensive than the auto industry median. And this really stuck with me, so later in the video I'm calculating the stock price at which Tesla would be valued in line with the auto industry median. At this price, the stock would be too cheap to ignore, and if we ever get there, I'll buy all the Tesla stock that I can get. But now, to understand Tesla's valuation better, let's see what is the PE ratio and why it is so important for investors. The PE is the price of the stock divided by the earnings per share, which is the net profit that a company can offer to its shareholders. The earnings per share is the single most important metric that decides the stock price of a company. Everything in the stock market is priced relatively to the earnings per share, so the PE ratio shows how much we're paying for $1 of net profit. And obviously, we will want to pay a lower price for $1 in profit. And let me show you a quick example with Tesla and Ford side by side. Here we have the share price and the 2023 earnings per share for both Tesla and Ford. Calculating the PE, we see that for Tesla we have a PE ratio of 75 times, while for Tesla we only have a PE of 7.5 times. This means that for $1 in earnings for Tesla we need to pay $75, while for $1 in earnings for Ford we only need to pay $7.5. That's a huge difference that a potential investor has to pay for the same $1 in net profits. But how is this possible? Because $1 today in net profits from Tesla equals $1 today in net profits coming from Ford. But for Tesla's $1 in profits, you pay 10 times more. So unless you hate money, why would someone choose to pay $75 instead of paying just $7.5 for exactly the same thing? And the reason is that if we stop at the PE, like many Tesla bears do, there's an important piece of the valuation that we haven't considered, and that's the quality of earnings. You see, I said earlier that $1 today in net profits from Tesla equals $1 today in net profits from Ford. But what we haven't considered is what these net profits will look like in 5 or 10 years.
Absolute price earnings ratios move up in respect to the earning power or the prospective earning power that is viewed by the investing public.
And here rises a very common misconception among investors. Here's a quote from Forbes saying that the higher the PE ratio, the more expensive a stock is relative to its earnings. But this approach has a big drawback, because it only considers the earnings for the next 12 months, or even worse, for the past 12 months. Anything besides that time frame isn't considered by the PE ratio. And as a general rule, a stock has a low PE because its future earnings are plain weak. The market doesn't believe that a low PE company will be able to grow its earnings power in the future. And the metric that will show us the earnings power of a company is the estimated growth rate for the earnings per share. For instance, Ford's earnings are estimated to hit $2 by 2027, growing an average 2% each year. On the other hand, Tesla is expected to grow its earnings from $3.4 in 2023 to more than $10 in 2030, which is an average growth of 17% every year. Moreover, the growth compounds even more as we expand the time horizon for our investment, so by 2030 we can see an immense difference in the net profits generated by the two companies. Now, if we come back to the data for the whole auto industry, we see that Tesla has by far the highest growth estimated for its earnings for the next 3 to 5 years. So, the correct way to value Tesla is to combine both the PE ratio and the EPS growth rate.
Combination.
And that's where the PEG ratio comes into play. The PEG is the ratio between PE and estimated EPS growth. So, a lower PEG is generally better because it means that we're paying a low price expressed by the PE for a company that grows its earnings fast. And when we look at the PEG ratio for the auto industry, things look surprisingly. For instance, Volkswagen, even if it has a PE of 5, which means that it's dirt cheap, when we take earnings growth into account, it is actually more expensive than Tesla. With a PEG ratio around 3, Tesla seems to be only twice more expensive than the industry median when accounting from the earnings growth. So Tesla moved from being 5 times more expensive than the industry average to only 2 times. Funny story, one of the most vocal Tesla bears has been asked if he ever looks at the PEG ratio for Tesla. And here's how he dodged the question.
Do you ever consider like a PEG ratio, so taking that PE dividing by growth, or do you solely focus on PE?
No. There's actually a chapter in The Intelligent Investor where there's a number of key points you want to look at before you invest in any stock. And I'm not saying you apply each one of those points.
Of course, yeah, sure.
But I like to buy low, sell high.
Right.
And a lot of these stocks are trading at generationally high multiples, and those are the stocks we try to stay away from.
Okay.
So this analyst basically said that he stops at the first step of the valuation and he doesn't even consider using a more suitable metric because the PE is really high. But if we look historically, it is not uncommon for fast-growing companies to trade at high PEs. There have been many companies with really high PEs which offer tremendous returns. For instance, Microsoft had a PE of 47 in 2018, and since then the stock price grew 200%. Facebook had a PE of 67 in 2015 and the stock grew almost 300% between 2015 and 2021. Lastly, let's see what would be the stock price at which Tesla would be valued in line with the auto industry median. Using the PEG median of 1.5, that would result in a PE of 38, which is around half of the 77 times that Tesla trades at. So, with a current stock price around $260, the price at which Tesla is valued at the auto industry median is around $130. The stock actually reached this price point during its bottom at the beginning of 2023, and then it grew an impressive 100% year to date because of the immense opportunity. But does Tesla deserve to be valued at the same multiple as other automakers? We can clearly see that Tesla is the leader of the next wave of transportation. Electric transportation is the future, and Tesla is by far the most valuable brand of electric vehicles, which will help it keep its leading position. Secondly, Tesla has immense optionality as it has many potential new revenue streams like the FSD, charging and other software services, not even mentioning Dojo or Optimus. I believe that the other car manufacturers are still trying to catch up, and as a result, Tesla deserves to trade at a higher multiple than its peers, which means that even if the stock might look expensive on the surface, it can still provide great returns in the future. To sum up, before saying that Tesla is expensive, please use the PEG ratio instead of the PE because it paints a more accurate picture for Tesla's growth potential. That was it from me. If you feel like you've learned anything of value today, or you want to see some more fundamental analysis regarding Tesla stock, please hit that like button and subscribe.